Any change, please let me know. I am
Yes,
just.
yes,
Yes,
the
yes,
slides are
it's changing.
changing now. You can
Oh,
start the
okay, great.
presentation.
Okay,
Okay.
great, great. Yeah. So thanks, Deepali, once again, and good evening, friends and clients. I welcome you to this session again, and I hope at this point of time all of you are doing good and your family members are doing well as well. So, as Deepali mentioned, this particular session we will be spending time on understanding the available tax saving sections, and within that, which looks good in terms of the return point of view, and also we will have a general overview about whatever options that are available. So the format of my presentation would be into three. First, we will have introduction about various tax saving sections and also the tax slab. And then we will talk about equities first. Since ELSS being an equity product, we will try and understand some of the thoughts around equity investing itself. And then we will touch upon ELSS and how that compares with other fixed income options. And then we will also have a overview about the insurance part. And then I can open the floor for questions. In the meantime, during the session, if you have any questions, please make a note of it. Or as my colleague suggested, you can type in the chat box. We will take it up at the Q&A session. So these are all the dilemma an investor have when it comes to the tax saving topic, right? So first is where to invest. So should I stick to the fixed income or the regular income option, or can I also choose the instruments with a growth potential? And what is the objective in the first place? Is it only tax saving, or is there a wealth creation objective as well? Or if that scheme has that option also? And how long should I invest? So should I, or do I have a specific period in my mind while planning to save for taxes in a financial year? Do I have a specific period in mind, or it should be in line with my long-term goals as well, right? And finally, the point is how to invest. Should I go for a lump sum investment, or should I invest systematically? So all these are general dilemma. Now, first we will try and see uh, the uh, a glance on the various instruments, the most popular instruments that are used for saving taxes, right? So we broadly classified this into three again. So one is the market linked options. Then you have the fixed income option. This I think most of the clients would be very familiar with. The PPF or the NSC and the bank FDs, the 5-year bank FD. And then you also have the hybrid option, which is the national pension system, right? Now, these are all the various parameters in which these are different, right? So I'll just hold it for a while so that you can consume the table. So you have the lock-in period, how the variations are, and then you have the minimum investment amount, maximum amount to be invested, or how the tax benefit is, right? So these are all predominantly the ATC benefits, ATC section. So you have the standard limit of 1.5 lakhs. And then these are all the average returns that these instruments provided over this longer period of time, right? So this is in glance, or this is a quick comparison kind of a thing, right? Now let us have a glance on the various sections that are available today, the popular ones again. So ATC is the most popular and the most crowded section as well. So in this, there are three types of investment or activities that gives you tax benefit. One is the investment into fixed income options, the investment into market oriented investment option, and then your expense or others. So the debt options, in debt options, you have the variations like the Public Provident Fund, EPF, NSC, for parents who are blessed with a girl child, you have this option, Sukanya Samriddhi, and people who are senior citizens have the senior citizen savings scheme, and then you have the tax saving FD, etc. And when it comes to market linked options, you have the equity linked savings scheme, ELSS, and ULIPs. And expenses also gets covered under ATC, right? So children's tuition fees up to two per family or two per assessee. Then the principal repayment portion of a home loan, and then the life insurance premium paid. So all this together has a limit of 1.5 lakhs. And then you also have a variation of 80 triple C, this is the pension plan from insurers provided by an insurer company. And then this is an exclusive 80CCD1B, which is the contribution to the national pension system, the new pension scheme, as people call it, and the tier 1 portion of it. That is a 50,000 exclusive benefit. And then you have 80D, which is again a very popular section. Health insurance premium paid for self and dependents are covered in this, parents especially. So if the self and parents are below 60 years, it is 25,000. And if they are above 60 years of age, it is 50,000. And then you have section 24, which is again a very popular section among the home loan borrowers. Then you have the interest portion. So in a home loan, you have two components, right? Interest portion and also the principal portion. So this captures the interest portion of it. And there are conditions subject to certain conditions because you have single house, multiple house, the period when you took the loan, etc. So net, the most popular section gives you the tax benefit up to 2 lakhs. And then you have 80E, which is the interest paid on education loan and so on and so forth. There are a lot of other sections as well. Now, all these are sections which are not quite popular and also not as applicable to everybody as the other sections are. Uh, Then you have, so this is a quick glance about the various tax saving sections. And then let us quickly understand the tax slabs because that has undergone few changes in the recent years. So you have today the old tax regime and the new tax regime. So these are all the income tax slabs. So the difference between these two is eligible exemptions and deductions can be claimed in the old tax regime. And in new tax regime, no deductions are allowed. So this is how the tax slab and the rates are divided across. The most important question is, which one is good, old versus new tax regime? This discussion or the question is going on for a while. So what we have done is we have compiled a kind of ready reference guide kind of a thing. And if these are all the gross income slab, and if your standard deduction is anyway available for everybody and there are no exemptions availed, then from 7.5 lakhs of gross annual income, new tax regime is attractive. Now, if somebody claims the exemption, standard deduction of 50,000 plus an exemption to the tune of 1.5 lakhs, let us assume 80C, right? From 10 lakhs onwards, up to 10 lakhs, old is attractive, right? So this is attractive, old is attractive. And from 10 lakhs onwards, new becomes attractive if only this much is claimed. Now you have standard deduction plus exemption. So this is 50,000 plus exemptions of 1.5 lakh. Now standard deduction of 50,000 and exemption of 2 lakh, totally 2.5 lakhs. From 12.5 lakh onwards, gross annual income, up to 12.5 lakhs, old is attractive. And beyond that, both are indifferent. So this is the very important understanding one should have, right? And so on and so forth. So what we are trying to say here is, in nutshell, new regime is less taxing if no exemptions are availed, as per the tax saving sections. But the question is, when individuals continue to save and invest for their future, incur the tuition fee expenses, you also have an insurance. These are all very basic goal planning activities somebody do, right? So to protect the financial uncertainties or to protect the family's welfare, somebody take insurance. That is a part of goal planning anybody does, right? And somebody has a home loan, they repay it. And when these are all eligible to be claimed under the existing sections, it is wise to opt for it and reduce the tax liability as long as these sections are prevailing as it is, right? So the higher one saves or allocates, the more old tax regime is beneficial, right? So this is a very important observation we have got because none of the other things changes. So if you look at it, the tax regime changed, the conditions changed, but the basic goal planning remains as it is, right? You need to save for your future. It's very advisable. It's good to invest, in different asset classes. It's good to protect yourself through the insurance plans, and you also have a kid and tuition fees are incurred. So I think all this remains the same. Nothing changed, right? So one should look at it from that angle, and we believe that uh, somewhere between this and this, right? So let me put it between this and this. I think old is grossly attractive across any scenario. So this is an extension of the previous slide. In previous slide, we had illustration, and this is like a ballpark figure. So from what level onwards, old becomes attractive, and I mean to say, from what deductions, when the deduction plus exemptions cross a certain threshold, at what level the old becomes attractive. So this is a quick reference kind of a thing again. Um, so we will now move into why equities. So as I told, we will be speaking about ELSS and ELSS as a tax saving option. So ELSS is predominantly a equity oriented fund. So let us try and understand first about why equities in the long run, right? So this is a very popular table from our side again. So this talks about the return from different asset classes across multiple periods. So let us assume that somebody is investing every year across fixed income, commodity, equity, and in equity, we have taken the reference point of Sensex and Nifty 500. This is the top 30 companies, and this is the top 500 companies of the universe, listed universe, right? So if you see, this is a heat map table. You can easily understand across different time frame, equity stands to outperform other asset classes in the long run. Very, very important point, right? So equity is probably an asset class that consistently outperforms the other prominent retail oriented investing options, right? A typical retail investor or a common person like you and me would look at all these as the investment choices we have, right? Financial instruments, right? So within that, I think by far across time period, equity outperforms other asset class in the long run. But whether that return comes in straight line, the answer is no. Equity, the chart in front of you actually talks about the entire journey of Sensex right from the inception, that is January 1986, all the way till December 2021. So you can see many events probably triggered a correction. Many negative events triggered a correction. But over a period of time, Sensex also kept achieving milestones. With all these corrections, market went up. So market is actually kind of volatile in nature. So how volatile is it? How volatile or how frequently this correction occurs, right? So before that, let me also spend some time in explaining. So what makes market to go up? So there are events it corrects when there are some events are happening. Markets are correcting. For example, let us go by the most recent one, the COVID-19 pandemic. Market corrected, but eventually market again scaled up, right? And now again you have the valuation concerns in between that. Again, markets continue to go up. So what happens in the long run? We believe market track two factors very closely. One is the listed companies' earnings, that's called corporate earnings, and the broader economy. Now, in order to corroborate this idea or this thought process, let us see this particular data, right? So this talks about the 1,000 point closing milestone of Sensex over a period of time. Now, during the same time, you see GDP of our country, right, was $327 billion in 1990, and today it is estimated to be around $3 trillion. We are somewhere around that. Earnings per share of Sensex companies was 59 in 1990, and today it's about close to 2000. So these two matters for the market in the long run. One, the broader economy, how it is doing, and the listed companies' earnings per share. These two are very, very important for the market, right? Rest of the things will create short-term blip in the market, but in the long run, these two matters for the market. So having said that, now let us try and understand how frequently correction occurs in the market. Whether is there any time period in which correction occurs? I feel no. Market witness correction every year. This is a very timely chart, I would say, because off late markets are correcting. So we are off by about like 4,000 odd points from the recent peak. And what we have seen is you should look at it from the perspective of these three, right? Historically, you see any calendar year, market has a correction, right? Sometimes it is price-wise correction or time-wise correction or both or multiple corrections also. So the nutshell is Average drawdown, what we have seen in the market over this 36 years is about 22.7%. And the average drawdown duration, what do you mean by drawdown? We refer to correction as drawdown. Correction means the market declines, right? So the average drawdown duration is about 4.25 months. And in 10 years, the drawdown spanned more than 6 months, as you can see here. These are all like time-wise correction along with price-wise correction as well. And 17 years, drawdowns were beyond 23% out of this 36 years, right? And 7 years to a multi-drawdown. For example, last year is a classic example. You had two distinct corrections of about 9% each, right? Both spanned for about like 2.1 months. So you had two corrections in the same year, distinct periods. Some occurred in the beginning of the year, some occurred probably in the middle of the year. It could be, right? But eventually, if you look at the calendar year end, right, 26 years out of 36 years, Sensex entered the calendar year positively. So what is very, very important and what we would like to convey to the investors in the outset is adding more investment during corrections. It gets rewarded handsomely in the long term. That is very, very important. So corrections do come in the market. Every now and then market corrects. Every year almost market corrects. But corrections is an indication that yes, I am available to you cheap because I have outperformed other asset classes in the long run, but I don't come in straight line. I witness corrections. I witness corrections almost every year, but over a period of time I go up. So when correction comes, you add it. That's the message market gives. Now the next question, how long is long term in equities? So we have tried compiling this through the Sensex rolling returns with a daily frequency. So this chart shows the probability of profit and loss across different investing time frame. If you have invested from any day to any day during this particular period, all right. So if let us assume this one, right? First point, if you have invested for 1 year in Sensex historically, 71% chances are there you make money, and there is a 29% chances that there is a loss. You move the needle little bit to 5 years, 94% times you make money, and 6% times there is a chance of a loss. And move the needle more to 10 years, 99% times you make money across any day to any day. My dear friends, please understand this means it covers all the cycles of the market. We have not left any day unattended, right? So any particular worst case scenarios have been captured in this particular analysis. So 10-year period, 99% times you make money, and there is a 0.9% chance of a loss in a period of 10 years, in the invested period of 10 years in Sensex, right? So the first observation is in the long term, the risk of loss reduces and the probability of profit increases with time horizon. First learning. Second point, returns becomes less volatile. So if you see the maximum and minimum returns for 1 year, this is the range, plus 263 and minus 56. Over 10-year period, the most maximum gain is 26% and the lowest return was minus 3%, right? And these are all the average return. So my point is returns becomes less volatile in the long run and the probability of profit also increases in the long run, right? Now, the third most important point, this is where equity becomes attractive. Probability of returns beyond average inflation goes up. So as you can see in this particular table, the long-term inflation in India is around 6.5%. So we have taken 7 as a hurdle rate, right? So if you keep 7 as the hurdle rate, in 10-year period, 86% times Sensex delivers beyond 7 and 74% times it gives beyond returns beyond 10%, right? So this is very, very important understanding for us. So how long is long term means, I think somewhere between say 8, 9 or 12 years, right? By this time, you have high and healthy chance of profit, right? So equity delivers return in the long run. So why we spoke about this? Now we are talking about ELSS as a scheme. So ELSS is typically a equity oriented instrument, right? So it will also carry the same qualities like a equity investing. So we took a index of say Sensex, an index as an example to understand how this also can behave, right? Now, for some of you in this audience who are very, very new to this particular concept of mutual fund, a quick glimpse of it. Mutual fund is an investment vehicle that collects money from various investors and that gets invested in the securities market. It could be an equity market or a debt market. Every scheme will have a common objective and that also describes the investment nature of that scheme. It is an indirect route to invest in or access the equity or the debt market. Very professionally managed. It gives you diversification across sectors at a very low cost, well governed and regulated by SEBI. Very, very high level of transparency of the investments and periodic disclosures. When I mention periodic disclosures, so for example, if one of you as an investor would like to know what are the securities or the companies in which your scheme has invested as of the last month, that is say December 2021 or January 2022, you can always go to their website and pull the data and check where the actual investments are made. So periodic disclosures are there, and this you can even track it back up to say 3-4 years back also. uh, Now, investment made by investors are represented by way of units. The price at which you transact is called the net asset value. It represents the market value per unit of underlying investments. It moves up or down. I mean to say the net asset value goes up or down in line with the net market value of the underlying investment of the scheme. So if the overall market goes up, market value also improves, NAV will go up. If market comes down, net value of the investment comes down, NAV will also come down. So tax planning through mutual funds. The instrument is called ELSS, Equity Linked Saving Scheme. They are eligible for tax exemption under Section 80C of the Income Tax Act. And ELSS funds are generally a diversified mutual funds. They invest majority of their corpus into equity market. So that is one reason where first we gave you an introduction of how equity should be viewed at, right? Hence, investment into ELSS are also subject to market and other risk associated with equity investment. Investment can be made through systematic investment plans, and we also highly recommend people to invest through SIP route for saving taxes by investing every month, or you can also go through the lump sum route, especially for people who have a good amount of shortfall for this for financial year to be reported to your company. You can go for a lump sum investment. Same time, you set up an SIP also so that your next year is taken care of. And all these investment will come with a 3-year lock-in period. And in the case of SIP, lock-in period of 3 years is applicable for each installment that you make. The tax limit is or the tax benefit limit is 1.5 lakh. And track record shows that ELSS funds have delivered higher return compared to the other ATC qualifying instruments. Now, what are the advantages? It gives you good amount of tax saving. It gives you better capital appreciation. It is well diversified. And all these are research-based active management of the portfolio. And it's very affordable. You can invest through SIPs. The way you plan your other monthly activities, you can also plan your tax saving through SIPs on a monthly basis. Very professionally managed and highly transparent. And it is an opportunity to participate in the economic growth of India. So very, very important point. Now, this is a quick understanding of the trend of the PPF rates over the years. So, at one point of time, PPF used to have a range of about 12-11%, and now it is hovering in the range of about 7.5 to 7%. So, fortunately, as of now, it has not dipped below 7%, but it is somewhere around 7% and testing the nerves every now and then. So this is the general trend, and this is a very interesting and popular chart. Again, very, very important chart to understand also for long-term investors. So if I have been investing if I have been in saving for my taxes through ELSS versus PPF, this is on a monthly SIP. So very simple kind of a activity. Very, very simple kind of an activity. No timing risk, no market level risk. I am just investing every month, right? I'm comparing that with the ELSS versus PPF. So now let's talk about, say, a long duration of, say, 10 years, somewhere in this range. We have about 27 funds that completed 10 years in India, and the average all all ELSS funds average return is 16, and during the same time PPF return is 7.8. And there is a last 5 ELSS, right? Last 5 funds, the bottom 5 funds, that average is about 13.4. So my dear friends, very, very important data point, very, very important data point. Yes, at times when markets are tanking, markets are correcting, your long-term returns probably will dip. But as we saw in the previous slides, fair amount of chances are there over a longer period of time that this will outperform. That's what we have seen. All right. So this is just in the same chart in number in some value terms. For example, all average 10 years. If you've been investing 1 lakh rupees, 5,000 rupees invested every month, should be standing at around 14 lakhs as of now. And this would be 1.55 times the value that you should have earned or accumulated over PPF through a PPF. So this is a quick comparison. So I'll just glance through this and this for few seconds. I'll pause it so that you can try and understand this, or if you have any questions, you can make note of it so that we can discuss that in the end of the session. Now, what is the taxation in mutual fund? Yes, there are two types of taxation. So, since equity linked savings scheme, that is ELSS, is predominantly a equity oriented fund, the taxation comes under this particular bracket. Less than 12 months is called short term. So, in ELSS, what happens is predominantly everything will be long term because there is a 3-year lock in period, which means 36 months somebody has to hold the scheme. So, everything default becomes long term. And the long term capital gain taxes up to 1 lakh per financial year, the gains are exempted. Beyond 1 lakh, incremental gains are taxed at 10%. So I repeat it one more time. Long term, more than 12 months. Since ELSS has a lock in period of 3 years, more or less everything or default they come under long term. First 1 lakh is exempted per financial year. And beyond that, it is taxed at 10% on the incremental gain. Right. So we have also mentioned about non-equity here, just in case if somebody would like to have a information about it. For non-equity schemes, less than 36 months is called short term, more than 36 months is called long term. Short term is taxed as per the individual tax slab, and long term is taxed with 20% with indexation benefit. So indexation is nothing but you're adjusting your values or the gains for inflation. Now, these are all the recommended schemes of recommended ELSS schemes by Geojit. I will again pause here for a while so that you can glance through this. And anyway, the same set of information would be available through our branches. So you can feel free to call them anytime and understand or get an information about the recommended schemes. It has all the information. So we have a good amount of list, and all these are all these I think are fantastic wealth creators over the long period of time. So uh, I'm just leaving it for a quick glance. The next question is how to transact. What are the various ways you can transact? So through branch, you can access through the terminals, the branch terminals, you can execute your transactions provided you have a demat account and trading account. If you don't have a demat account and trading account, still you can invest through the mutual funds through the application form route, or you can request the branch to send you the online transaction link. They will generate and give it to you. You can click that and complete the payment online. So this is also possible. Or if you're an online investor, you would like to do it yourself, yeah, most welcome. You can do through the Selfie platform of ours, or through the mobile funds genie app, or through the customer care. So all these are possible. I think making a transaction is per se very easy. Now I'll pause here for a while. Next we will go to insurance. So in insurance, I'm not going to spend more time explaining about the various needs of having an insurance. By this time, I think most of us must be aware of the need for protection for all these years, and especially the need or the understanding about having an insurance or the need would have gone up in 2020 and onwards, right? So I'm not spending much time into it, but I would like to summarize the whole thought process that I have in 3 or 4 slides only, right? So first is why insurance. It's to protect against the financial uncertainties of life, and to make good any financial loss arising because of the risk or the uncertain event, and to have a sense of security and peace of mind throughout, right? So let us talk this with some scenarios. So this is the expectation we have on life, right? We have savings and the individual survives and everything goes fine in life, right? So year one, you started saving, everybody started saving, we all save, and these are all for the future goals. And we, provided we adequately save and regularly save, follow the discipline, etc., etc., we achieve the future goals conveniently. Now let us talk about the uncertainties in life. This can't be avoided again, right? So what happens is you have savings, but there is an uncertainty after a few years, right? So there is only savings here. End of say, or in the sixth year, some uncertainty even strikes here. What happens to the goals? So the goals and family safety becomes a question mark, right? So this is the problem. Now, what is the solution we have? Start an SIP for your monthly savings and future goals. Plus, have a term insurance for yourself and also go for a good health insurance along with your investment and stay financially secure. So, what happens? You set up an SIP, monthly SIP for your goals. Also, take a term and life insurance, term insurance, and also health insurance. Some uncertainty strikes. The fund value of personal saving remains intact. Whatever the SIP that you're accumulating, that is remaining intact. Plus, the uncertainty, the cost of that uncertainty is met by the insurance plans. So you are safe, goals are in line. Families' goals are in line. So, my dear friends, please understand, when I have a goal, it is not my goal, it is my family's goal. The goal is for my family, right? That should not be left in question, that should not be left in lurch. Hence, this combination works well, right? So goals are in line. Family at least will have a visibility of managing that kind of okay, right? I would not say anybody can plan it 100% accurate, except for you have a questions and exams, perfectly fine. But in life, you should be there somewhere nearby that area, right? So that is very important. Sometimes you will be exceedingly doing well also, but net, I think most of the goals should be planned, right? So that is in line. So once you have a combination of this, so that the personal savings doesn't get eroded all of a sudden. So what are the broad variants we have in insurance? Life insurance, health insurance, and general insurance. Now quickly, some points or thoughts around health insurance. Why we should have a health insurance? By this time, all these points are kind of seen by you or experienced by yourself also in a way or other. uh, so increasing cost of medical treatments, newer health troubles due to lifestyle changes, or I would say the lab is not kept proper. That is also possible now. Your lifestyle is intact, lifestyle there is no problem. But if a lab in some part of the geography in the world is not kept properly, right, there also newer health trouble may come, right? We have seen that. Uh, it offsets the medical cost incurred when you have an insurance and you go for cash settlement and tax benefit under section 80D, which is what we are going to understand right now, which we have seen already also in some of the slides ago, some of the slides before we saw that, right? Now, if all the members are less than 60 years of age, for self, spouse and child, it is 25,000, and for parents, it is 25,000. Totally 50,000 under section 80D. This is the amount which one can claim. Now, self and family is less than 60 years. They can avail up to 25,000. If parents are more than 60 years, which is the most prominent slab, they can go up to 50,000. The total claimable amount is 75,000. Now, if all are beyond 60 years of age, they can claim up to 1 lakh. The person who is paying, who has taken the insurance and paying the premium, can claim up to 1 lakh. These are all the limits available. Now, talking about the partnerships we have. So now this is understood. Now, if I wanted to go for it, what are the kind of plans I can look for or expect in Geojit? Yes, very well. You can get in touch with our branches. All our branches will be dealing with all these policies because they are all certified under the as per the IRDA regulations. So for life, we have the partnership with ICICI Prudential Life, HDFC Standard Life, and PNB MetLife. And for health plans, we have tie-up with Manipal Cigna and Star Health. Both of them or most of these partners have one of the most competitive rates available in the industry. And for general, we have tie-up with Bajaj Allianz and ICICI Lombard. So these are all our partnerships under this particular segment. So with this, I will stop here and I would be happy to take any questions if any. Thank you.
Thank you, Sriram. There are quite a few questions actually. Do you want to take a 2 minute break before we carry on to the questions?
We can proceed with the questions. Yeah.
Okay, to start with, Mr. Sundaram Sundar wants to know, is general mutual fund applicable for tax saving like ELSS? Do all the mutual funds have ELSS option? And are all their funds available eligible for ELSS?
So I missed your first part. What is that? Can you repeat, please?
So he's typed it out as, is general mutual fund applicable for tax savings like ELSS?
Uh,
So I'm assuming he means, do all mutual funds have ELSS schemes, or are all the mutual fund schemes eligible for ELSS?
Yeah, so ELSS is a designated fund. If an AMC is offering 10 different equity funds, not all 10 different equity funds will be qualified for ELSS benefit. There will be schemes that are earmarked for ELSS and they are specifically called as the ELSS schemes, or they would carry some words like long-term equity and all, but they should have the nomenclature of eligible for tax benefit under Section 80C. They are the schemes that are qualified for investments and ELSS benefit. Now, if you look at the India experience, we have about 40, 41 odd active AMCs, and maybe 38 or 39 of them has ELSS schemes. So in India, you have about 39 or 40 odd schemes. I'm assuming like that.
I'd like to
So
give a few inputs here. ELSS primarily means equity linked saving schemes. Yeah. So these schemes, like the name suggests, invest in stocks, equity markets for you. And because they offer you a Section 80C tax benefit, there is a 3 year lock in period for these schemes. So whatever money you put in these schemes, it's going to be locked away for 3 years. And the entire amount, so for example, the eligibility for ATC is 1.5 lakh rupees. So if you're going to invest 1.5 lakh rupees in an ELSS scheme, the entire 1.5 lakh rupees is going to get locked away for 3 years. You cannot touch it. However, that does not mean you cannot invest at any point. The scheme is open for investment any point during the year. However, whenever you put your money in that investment, it gets locked away for 3 years, and that money is eligible for your Section 80C tax benefit. One more point here, some people seem to think that whatever money gets put in ELSS schemes is eligible for tax saving. So if I put in 10 lakh rupees, 10 lakh rupees comes under tax saving. It's not like that. 1.5 lakh rupees is your limit. So if you're going to invest 10 lakh rupees in an ELSS scheme, you will get tax benefit up to 1.5 lakh rupees. But the entire 10 lakh rupees is going to get locked away for 3 years. Also, we have noticed when we do our research in mutual fund returns, we've noticed that ALSS schemes tend to give us better returns than most of the other open-ended equity schemes, which is probably because the fund manager also, when he's investing your money in different stocks, he keeps the money away for three. He knows that this money is not going to be immediately to be redeemed because there is redemption pressure from the investors. So he can take slightly long-term calls in that sense. So ELSS typically gives us much better returns. If you're looking for tax benefits, it's a great scheme. Even if you're not looking for tax benefits, but you know you're not going to need this money for more than 3 years, you can actually think of putting your money in ELSS there. Sriram has just shared a list of schemes here. These are the schemes which are rated by Geojit. Geojit rating is 5 star for Mirai Asset Tax Saver Funds and Canara Robeco Equity Tax Saver Fund. Plus, there are, like he said, out of 40 odd fund houses, there are 38 fund houses have an ELSS scheme. Not all of them are the best performing ones, but we have listed out here which are the top performing ones as per our investment advisory services. I hope this answers your question, sir. I'll go to the next question. Sriram, one of our investors wants to know, what is the benefit if we use new regime process vis-a-vis the old regime process? Can you give some examples?
yeah, so as we have explained in this particular, one of the slides, let me just go back to that. So the differences on the claiming of the deductions. So in new tax regime, one cannot claim the deductions, and in the old tax regime, one can claim the eligible deductions, and uh, that is how it is. So if somebody is not claiming the exemption, then new becomes attractive from this level, and if somebody is claiming various eligible deductions, then uh, new becomes attractive beyond certain threshold. That's what we are tried compiling in this. So, for example, if standard deduction is something you get by default by the law, right? So that is 50,000 plus exemptions of 2 lakhs. So it could be a combination of 1.5 lakhs in ATC and 50,000 in health insurance. All right. Now this is without a home loan, which means anybody probably would have it. So what happens is you have the attraction, or the world becomes attractive up to 2.5 lakhs of gross annual income, and beyond that both becomes neutral. But here again I would give remarks, or I would give weights to hold, because the amount that you are saving here are for two key purposes of life. One, your goal planning partially, and point number two, protecting your family in case of financial uncertainties. These two cannot be undone, right? So which is a good activity, and you by law you have a eligibility, so why not avail it? So I think old scores here beyond any level also, I would say.
Thank you. Um, this is for everybody's benefit. Mr. Rohit has said I ended up joining late and can we get a recorded version? Yes, all our e-Gurukul sessions, once we finish the sessions, we do a little editing to take away all the unnecessary part at the front and the end. And then we end up putting it on YouTube. We have a YouTube channel under the name of Geojit Financial Services itself, in which we have a playlist called e-Gurukul. So you will see all our recorded sessions in e-Gurukul playlist on YouTube itself. Mr. Karthik wants to know, can we continue to be invested in ELSs post the lock-in period? If I may
Yeah.
take this is one of my favorite funds actually.
Yeah,
So
so
yes,
you don't have any upper limit or holding period kind of a thing. As long as the scheme is existing, you can also continue to invest or continue holding on to your investment, I would say. But once it completes the lock-in period, we normally suggest a review of all your mutual fund investments for after a certain period. So as part of your review, overall portfolio review, if you feel the particular investment can be reviewed and shifted to another particular kind of a equity oriented scheme, or in that particular year you want to migrate it to an ELSS, you can very well do that. But per se, you don't have a constraint in holding the investment.
correct. So, Mr. Karthik, I hope this is clear. There is no mandate that after 3 years you have to pull out your money. You can stay invested, but we very strongly suggest that you review the performance of the schemes in which you are invested from time to time. So, if you are happy at the end of 3 years and this fund is still doing well, continue being invested. In fact, every year you should add into your ELSS fund. Okay, that is what I would personally suggest. And if you're not happy at the end of 3 years, you can always shift the money to another scheme that is probably doing better. Can we start NPS through Geojit for getting over and above the 1.5 lakh limit?
Yeah, at present, no.
Yes, at present we are not a distributor for NPS. There are very limited number of distributors for NPS actually. So we are not in the picture for NPS. However, we'll be happy to help you connect with locally wherever you are staying. If you need to be connected with someone who is doing NPS, our branch manager will be very happy to help you with this. How do returns on ERSs compare with mid-cap mutual fund returns?
Uh, well, so we have the data, but not in this presentation. Now, and I'm not that good technically to quickly migrate to that. But what I feel is, if my memory serves me right, mid cap and small cap over a 10, 12, 15 year kind of a period. I'm talking about an SIP, by the way. Okay, I'm assuming that all these. Let us keep a common kind of an activity, investment activity, so that the outcome is clear and it's common for all. So in a SIP kind of an investment also, I think mid cap, small cap tend to outperform the other equity categories over a 10 plus, 12 plus, 15 plus kind of a scenario. Equity linked saving scheme, that is the ELSS piece that we are talking about, would more or less compare with the equity flexi cap, because the style is more or less same. So in equity flexi cap, what happens today? Predominantly, the fund manager will hold their positions in large cap, followed by mid cap, and followed by small cap. This is the typical weight on the market cap curves that they hold, right? It is also very reflective of Nifty 500 as an index, I mean to say. So flexi cap, equity linked saving scheme, more or less will have a similar kind of a return. right? But mid cap, small cap tends to outperform in the long run. But occasionally, like for example, during times of drawdown, like what we saw in one of the examples somewhere, yeah, here. So maybe this particular year, say 2020 drawdown, probably mid and small cap would have underperformed the other peers. But what I'm telling is in the long run, say for example, you completed 10 years or you're looking for 8 plus 10 plus kind of a long term. So India experience says that mid and small cap outperforms flexi cap.
To get the best of both worlds, in fact, there may be some ELSS schemes with the objective of investing in mid cap, small cap, and large cap, multi cap kind of a
Few
environment.
few might have. Yeah, that's a very good
Yes,
point. So in
yes,
our recommended list itself, if you look at the portfolio, you would understand how many are large cap biased and how many are mid cap heavy. Few
correct.
might have it. So
So,
you can choose if you are an investor with a flair of equity risk, you have a flair of taking higher risk, you can go for such funds which has a mid cap heavy exposure.
correct. So when a fund is launched, right, when you invest in a fund, you need to look at the objective. The objective will tell you where the money is going to get invested, whether it will be in large cap, whether it will be in mid cap, small cap, or in a multi cap kind of an environment. ELSS is just a benefit that the fund is offering you. The fund manager registers his scheme for ELSS benefit. It has it is not really related to the objective of the scheme. Objective of the scheme is to generate returns for you over a period of time by investing in a particular market, equity market, but within that large cap, mid cap, small cap, etc. So when you're looking at ELSS scheme itself, like Sriram just said, there are a few schemes in this list also where they're investing in multi cap. You have some large cap stocks, some mid cap stocks, some small cap stocks, and you can actually get the best of both worlds. You can get the Section 80C benefit as well as the returns that your mid caps are giving you. Is that right, Sushila?
Yeah, yeah, true.
Perfect. Okay. Mr. Vaisak wants to know, I already have one ELSS fund. Can I combine my ELSSs to a single one because I will be investing yearly and it is hard to track different funds on a yearly basis?
So yeah, the question is done.
Yes, yes.
All right. So to quickly two things again. So if your scheme is doing well and you're happy with it, you can continue your next TLSS investment in that same. So I'm assuming that this particular type of an investment is like you're investing every year. So probably it could be a lump sum. My suggestion is, especially when you have this tracking issues, right? Put it as an SIP. So in SIP, what happens is two things you achieve. One is you need not have to time the market cycles or the levels of the market. Anyway, that's a very tiresome and impossible exercise. SIP averages out over a period of time. And point number two, you get that continuity benefit in that, right? So that's point number one. The first point is your scheme is doing well, you would like to continue doing in that, you can add up to it. Now merging two schemes means I'm not getting that question correctly, so I'm assuming that
Let
can
me
you merge
answer
the
that one.
folio?
I actually understood what he's asking here. So, Mr. Vaishak, if what I've understood right is you're saying you've already invested in scheme A, one fund house, one ELSS scheme. Now, second year, another scheme is doing well. You probably want to invest in another scheme, and you're asking whether it's possible to merge these because then you would want to track it. It's so much easier to track these, right? You can shift your funds from your first scheme to another scheme only after 3 years. So no matter what you do in ELSs, the money gets locked away for 3 years. So if you've invested, let's say, in the Axis Long-Term Equity Fund, which is an ELSS fund for in the first year. Second year, you invest in Canada Robeco Tax Saver Fund. Third year, you end up investing in the DSP Tax Saver Fund. You cannot merge these right away. Only when access is free after 3 years, you can shift it to your scheme of choice. Only when DSP is free after 3 years, you can shift it to your scheme of choice. So remember, no matter what, whenever we invest in mutual funds which have tax saving benefits, and of the various tax saving products available in the market, this is the least lockdown wala, least one with a lock in period. Only 3 years is the lock in period. So you can definitely merge these, but after the 3 year lock in period is over. I hope this solves your question, Vaisak sir. So the schemes which are shown here, our recommended ELSS schemes, we have our own blog spot. I will share the link to the blog of ours in this chat box itself. And you can every month we refresh the list of schemes which are being recommended. Usually, schemes which are doing well in the longer term tend to do well, and you will see not many of these change in their star rating. The star rating is given on the basis of what is the kind of risk the fund manager is taking, what are the kind of returns with respect to the risk that he is generating. So there are various parameters. It is not just the highest returns alone, but there are different parameters that we take into consideration before the Geojit rating is given. This will be available on our blog on a regular basis. Over and above that, if you talk to your relationship manager or your branch manager, he can send you a WhatsApp of this every month. He gets a WhatsApp version of these analysis from Geojit's investment advisory team every month, and you can ask him to share that with you. He'll be very happy to do that. So, I think we are at the end of our session, Sriram. The questions have also trickled
Okay.
down. But this was a very, very useful session, like I said, given the timing, the time of the year that we are at. So, and this is the time when all the employers especially start asking people to submit their investment proofs. So, I hope this has been a beneficial session to all of you who attended this patiently today with us. Thank you so much for the continued support we are getting. Every session we do, we usually invite 500 to 600 people, and we are getting at least 300, 350 people attending. So, that really gives us a lot of motivation to keep coming up with new ideas for doing these sessions. Like I said, we're keeping the chat box open for a few more minutes. Give us more suggestions for what kind of sessions you would like us to take up. Yeah. And be safe. Continue investing with Geojit Financial Services. Please reach out to us if you have any doubts, any help you need at all. We have a huge network of branches. We are one of the very few brokers who have such a large network of branches. The branch managers, the financial consultants, the BSCs, the dealers are all well certified, well trained employees who will be very happy to help you out. And we at the head office also are usually available on our mails, on our channels itself. We are available on all the social websites now. So please feel free to reach out to us. And thank you so much, Sriram. It was a very patiently, very easily explained session on your part. And we look forward to another session on SIPs from you sometime soon because somebody's asked for an SIP details session as well. Yeah.
Yeah, thank you. Thank you, Deepali, for organizing this, and thank you, colleagues and clients who have joined in, taking your time out of your schedule. I wish and pray to God that you and your family members are staying healthy and safe. Thank you.
Thank you so much. Thank you, everyone.